Hello investors, welcome to Simpli Stocks. These days, a new kind of scam is happening in the stock market, which I will call the semiconductor stocks scam. I was observing that many influencers and news websites, and I won't target anyone individually, are repeating the same stories again and again that the semiconductor sector is a high growth sector. These are the best semiconductor stocks in India, which are the best opportunities, what Modi ji said, and so on. But if you go and study those companies yourself properly, you won't be able to find facts that support this storification. So in today's video, we will study semiconductor stocks in India and we will find out whether there is actually some value in them or if they could be the next trap for retail investors. So without any delay, let's begin. So see, in this video, we will not go into too many details about the semiconductor sector or businesses. Our focus will remain more on valuation and investment psychology. Still, if I give you a simple overview of the semiconductor industry, then there are three parts to it. First is their designing. Second is their manufacturing, which is also called fabrication. And the third is back-end assembly and testing, which is also called OSAT or outsourced assembly and testing. In India, most of the companies that are entering this semiconductor space are coming into the semiconductor assembly testing or the later stages. For example, Kaynes and CG Power are setting up OSAT plants. Setting up a fabrication unit requires very high investment and also a lot of expertise. That's why you will see that only big names like Adani and Tata are setting up plants in Mumbai and Gujarat. Their semiconductor businesses are not even listed, and Adani Group has also paused its plans. I think as per my last memory, they are having troubles in finalizing their joint venture partner. So here you need to understand two things. First, the semiconductor sector in India is still in very early stages. We just don't have enough opportunities right now. This sector is very big and there is a lot of scope, but there must be opportunities in the listed space, right? Now, the second thing you need to understand is that even though all listed players like Kaynes or CG Power are setting up OSAT plants, you have to check how much contribution will actually come from semiconductors in their total sales and profits. And it is also worth noting whether at their current valuations, the future value is already captured, meaning all the growth or all the return that was supposed to be earned, has it been already made? Let us look at individual businesses so you will understand it better. The first business we will look at is ASM Technologies. This company does product engineering, research, and design work for semiconductor and auto companies. If I simplify it, they provide various kinds of services to those companies that make components and machines for semiconductor plants. Now look, ASM is showing very good earnings growth, and 3-4 days ago, they also announced a plant in Tamil Nadu with an investment of 250 crore rupees. But my concern here is on valuation. You will see this business is trading at a P of 140 to 150 right now. In the case of ASM, one big thing that is sold in the market is that it is Mukul Agarwal's portfolio stock. And on top of that, people have made a fuss that he has recently increased his shareholding from 6.5 to 11.7% in ASM in August. But that is not the complete picture, I'll tell you. Actually, last year in March, ASM had announced a fundraise of 170 crore rupees. This fundraise was done at 461 rupees per share price, in which they raised money through equity shares and warrants. What happens in equity shares is that the investor immediately gets the shares and their money goes into the company. Warrants work in such a way that you kind of get right to invest in shares. Later, you may or may not exercise it. It is up to you whether you want to give the money or not. So last year, this 6.5% stake was bought by Mukul Agarwal at 461 rupees per share. At that time, ASM share was trading at around 900 rupees levels. So you and I would have bought the share for 900 rupees, but Mukul Agarwal picked it up at almost 50% discount. And now the additional 5.2% stake that he has taken, he has simply executed his warrants. He has got these shares also at the same old price of 461 rupees per share. Whereas today, ASM is trading between 4,000 and 4,500 rupees levels. Now, just think for yourself. The stock you are buying for 4,000, 4,500 rupees, Mukul Agarwal bought it a year ago at just 10% of that price. His investment has already grown nearly 10 times, and now this is trading at a PE of 145. But the story going around is that ASM is Mukul Agarwal's portfolio stock, that it is a great opportunity, etc., etc. Now, maybe you will come to fight me in the comments saying, look at the future potential, look at the growth. But dear sir, you should also look at 145 PE. The market cap is just 5,700 crore rupees right now. In my understanding, this valuation is extremely high for this business. After ASM, let us look at two most popular names, CG Power and Kaynes. Both of them are setting up OSAT plants, meaning units for semiconductor assembly and testing. And both of them have valuation problems. Kaynes is currently trading at a PE of 150 and CG Power at 125. Kaynes market cap itself is just 50,000 crore rupees. This is a very premium PE. This year, they have a target of 60 to 65% sales growth, on which their forward PE comes to 100. But even that is a very expensive valuation. Similarly, CG is also trading at a PE of 125. And if we compare growth-wise, its growth rate is half of Kaynes. And the problem with both of them is that we will have to see what percentage contribution or share semiconductor businesses will have in their total sales and profits. Kaynes is doing a capex of 3,400 CR and CG Power is investing almost double of that amount, I think around 7,600 CR in its OSAT facility. Kaynes is in the electronics manufacturing and PCB business. CG Power has a portfolio of power products and railway products. And if we take a rough assumption of 0.8 asset turnover ratio, in the future, around 15 to 25% of their business will come from the semiconductor segment. Even there, management has said that for now, you should not expect very high margins. You may get 1 to 2% extra incremental margins there, but beyond that, there is no commentary from management right now. So you see, we don't even have enough solid data that we can do a valuation of Kaynes and CG Power from the point of view of their semiconductor businesses. And based on their current business segments, they are very overvalued. I have seen that people don't accept that fast growth can also come in traditional or simple sectors. Even there, you can get low PE, high growth opportunities. What happens is that retail investors keep chasing trending sectors and trending companies, which are mostly available at very risky, very high valuations. And then they suffer huge losses there because they are entering at such high valuations. You have to look for growth and valuation, even if you get it in very simple traditional sectors. For example, we are seeing that right now in the jewelry space, many good high growth businesses are trading below 25 to 30 PE ratios. And you won't believe, but many of these businesses are growing their sales and profits at a rate of more than 30 to 40% right now. But nobody is talking about them. So this Saturday, 20th September, we are doing a live webinar or workshop on the entire jewelry sector in India. In this, we will discuss the entire jewelry sector, which are the top companies, where there are opportunities right now, and what are the risks, everything in detail. And I will also share which businesses I am invested in right now. This workshop will start at 11 a.m. and will end at 12:30 p.m. It will last for 1.5 hours. And in that, we will study the sector and companies for the first 45 to 60 minutes. And in the last 30 to 40 minutes, we have kept that for question and answer session to clear doubts. This webinar will be online and the fee to attend it is just 299 rupees. In just 299 rupees, you will learn how a sector works, how to study companies, everything. Please note that although this channel is in English, but the workshop will be in Hindi or say English language. So if you are interested in joining, you can WhatsApp on this number. Otherwise, we have also given you the link in the description. You can also contact through the link and join this webinar. Now, if we quickly look at the remaining businesses, there is this SPEL Semiconductor. This company has been in losses continuously for the last 10 to 11 years. Nothing is left in the company and the reserves are also negative because of losses. And the stock's book value has dropped to just 2 to 3 rupees per share. They only have the word semiconductor in their name. But still, while making this video, I noticed that in the last 1 month, it has rallied 75%. God knows what is happening in SPEL and only God can save its investors. Along with SPEL, let's also look at MIC Electronics. This company makes railway signaling systems and LED displays. The problem with MIC is that it is a very volatile business. In one quarter, their sales and profits are good. Then in the next quarter, they fall all of a sudden. Now, the issue here is that the management does not do conference calls with investors and they don't also release investor presentations. So we have no idea in which direction this business is going. Apart from that, this business has been trending too since the past 1 week. News has come that they are looking for a partner to set up a semiconductor fabrication plant. Since the company made this announcement, its stock has rallied 35 to 40%. But you should understand here that right now this is just an announcement that they are thinking of doing something like this. First, they have to find a partner. It is such a small company, there is no guarantee whether they will be able to find a partner or not. Then after that, they will have to go to the government for subsidies. Even there is no surety. The government also evaluates many things before giving such a big tender. Tata, Adani, Murugappa Groups, CG, or Kaynes have got subsidies, but look at how big, well-known, and respected businesses they are. Then they will have to raise capital for investment. So all this will take a lot of time, and there is no guarantee that MIC will actually enter into this business. But still, this business is trading at a P of 180, and its market cap is just 1700 crore rupees. So there is no value for investors here either. Moschip has good growth, but here too valuation is a big red flag. You will see this business is also trading at a PE of 130. Apart from that, Moschip has also stopped releasing investor presentations since last year. So again, my concern here is how can I take a position in 5,200 crore market cap business at a PE of 130 when I don't even know in which direction the business is going. There should at least be some idea about their future plans, growth, and guidance. And even for large caps, a PE of 100, 150 is considered very high. Here, despite being a small cap business, it is trading at such premium valuations. See, I am not holding your hand or stopping you from investing anywhere. If you want to jump into the fire, go ahead, be my guest, jump. But then there is this one thing: don't lie to yourself or others that you are investing. This is pure 24 karat gambling. Second thing, tomorrow when like railway, EV, or water management stocks, you start to face losses, don't ask how did this happen. People are not understanding that almost all semiconductor stocks are being storified a lot right now. There is a very big risk of capital loss in them right now. The same thing happened 1.5, 2 years ago with EV and railway stocks. And look at it this way: if you are buying these businesses at 100, 150 PE, it is not like they will double or triple and start trading at 200, 300 PE. After rallying so much, the upside in all of these is quite limited from here. And whenever you are investing in a business, along with returns, keeping capital safe should also be a priority, right? There is a very famous book in the world of investing, The Intelligent Investor by Benjamin Graham. It has a very good definition of investment. I'll read it for you. Investment means an operation which, upon thorough analysis, promises safety of principal and an adequate return. Meaning, investing has three very important things. First, thorough analysis, meaning you have to properly study the stock. On this, I can give you in writing that more than 50% of retail investors who are putting money in these companies don't even know what these businesses actually do. Second point is safety of principal, meaning your capital should remain safe. And the third, adequate return, meaning you should get decent returns. You can see that more emphasis is on safety of capital than on high returns, because if you lose capital, it can take you 3 to 4 years just to recover the loss. But people are simply not understanding the risks associated with all these stocks. Anyway, the eighth and last business we will study is RIR Power Electronics. They make semiconductors for power products. RIR is setting up a silicon carbide fabrication plant in Odisha. Their plant will start in May next year, and it will take 2 to 2.5 years to scale up and take capacity utilization to 90%. Their management has estimated that in 5 years, meaning by FY30, they will be getting 1200 CR sales from this plant, and this can bring 25 to 28% net profit margins. They have given very big guidance. If we compare RIR to its current situation, even CG and Kaynes will not have such high margins. That's why you will see this stock trades at a very high valuation. Like you will see last year, RIR had just 86 CR in sales and on 10% net profit margin, about 8 crore net profit. They have a target to grow sales to 15 times in 5 years, and along with that, they are also talking about margin expansion. They have talked about 25 to 28% net profit margin. But in my view, we should be conservative here. If we assume 20% margin, then this business will be at a PE of 10 on FY30 estimated profits. That is 5 years from now. In Q1, right now, it is at a PE of 300, and actually 300 is on FY25 profits. In Q1, their profits have fallen. If you see on screener, it shows straight 350 PE. So in my view, the entire value is already captured in the current valuation of RIR. I will not call it overvalued because the guidance is so heavy, but I will not call it undervalued either. And 5 years is a very long period. Anything can happen, from management issues to risk of delay in getting the plant started. So when you are buying a business purely for growth at a PE above 150, 200, you are betting that even 1% problem will not come. That's not how businesses work, right? There will always be some risk. So you can keep this business on your radar. Who knows, if a correction like Trump tariffs or COVID happens again, its valuation may become attractive. At current PE of 300, 350, this is a very bad, very risky deal. So these were your semiconductor businesses. Otherwise, if you are truly looking for good opportunities with reasonable valuations, I would recommend that you attend our jewelry sector workshop this Saturday. Its price is just 299, and in just 1.5 hours you will properly understand the entire jewelry sector and top businesses, their growth and valuation, and you will learn how to actually study businesses, how to control risk, everything. The link is in the description. And lastly, if you like this video, do give me a thumbs up. This is the first time we have tried such a video. If you support us, we will be much more motivated to bring such videos for you. And you can also subscribe to our channel. For us, your likes and subscribes are our only motivation, so that we keep bringing such high quality research videos to you for free. So do like the video and subscribe to the channel. I'll see you in the next video. Happy investing.